of what you're looking for, how much you're looking for, why you need it, what your business is going to do as a result of all of that. So this process is meant to sort of like give you an insight into all of that. And the very first thing I want to give you an idea of is what the journey of becoming investment ready looks like. So we talked about investment readiness. Again, this entire process is built to help you get ready to raise capital. And what does investment readiness look like? The very first thing you need to have in the 7-step journey towards investment readiness is that you have what we call business model clarity. What business model clarity refers to is that you have absolute clarity around how your business operates and how your business generates revenue. So how you make money, how you make the product that you sell, who you sell it to. So the entirety of how you create value, how you deliver value, how you capture value has to be very clear. So it's one of the things that a lot of people confuse, particularly when it comes to business model, is saying, sometimes you ask people, what is your business model? They say, oh, we're a B2B business, or we're a B2C business. It's not wrong, it's just incomplete. If you think about what a business model is, it comprises of two primary models: the operating model and the revenue model. So when you think about your business model, you need clarity around your operating model and you need clarity around the revenue model. What do I mean by operate? So let's take them one after the other. Operating model. Operating model primarily refers to how your business creates value and delivers value to customers. So in a technology company, your operating model is that you are developing a platform, right? Hence the reason why you hear a lot of technology companies say, oh, we built a platform, we built a platform, we built a platform. Your as a technology company, you develop a platform. That's how you operate. The thing that gives value is the platform itself that you developed one time. Then the way you generate money could differ. It could be we license our technology to this customer, or it could be we sell us technology on a subscription basis, right? So it's a subscription model. That's a revenue model. Or it could be a license model, or it could be a service model, or it could be a trading model, right? So, but if you're thinking about operating models, we're talking about platform build, we're talking about trade, which is where you buy and sell goods. You're talking about creating intellectual property, which is very, very close to what you do because you're creating it's creative material that is created that you can license. You're talking about manufacturing. You're talking about things of that nature. You're talking about services. You're talking about e-commerce. All of those are operating models. They are different ways of structuring how you deliver your products and how you make the products that you sell. And then revenue model is how you generate revenue from it. There are many revenue models. There's rental, there's usage-based, there is licensing, there's franchising, there is software as a service, SaaS, subscription, generally speaking, cover software as a service, and a number of other types of revenue models. There is trade, there is commission, there is affiliate. Those are all different types of revenue models. So for your business, you need to be absolutely clear around what your business model is. Number one, business model clarity. But it's not enough to have absolute clarity around your business model. The second thing you need to do is have a clear strategic outlook. Why is this important? The reason why you're raising capital has to be rooted in the achievement of a higher objective. It has to be rooted in the business being able to get to a point that it currently isn't at now. What you really are looking for is a vision that you have in your head that you want to bring to life, which you believe, when executed, is going to bring much more value to everybody involved. So we're going to make more money, investors are going to make more money, we're going to be able to hire people. That's the level you're looking for. So the second point in your investment readiness journey is painting a very clear picture of that growth objective. So I say this all the time. Every business wants to grow. I have never met an entrepreneur that has said, we don't want to grow our business. But oftentimes, entrepreneurs don't have a clear picture of what growth looks like. What is growth? What does growth look like for your company? Growth means many things to many people. For some entrepreneurs, growth is being able to serve 1,000 customers because currently they're only serving five. For some businesses, growth is being able to set up a manufacturing facility in Guatemala because they want to do social impact work through their business. For some businesses, growth is making $1 million or £1 million. For some businesses, growth is getting to 30 employees. Growth looks differently to different people. But actually, when you dig beyond the surface, there are a lot of commonalities to many different businesses in terms of what they look for in terms of growth. So what you get to see with all these examples that I gave, for example, is the entrepreneur putting their own personal spin on the growth picture. But ultimately, there are a few metrics that serve as common denominators to all businesses that you can measure growth by, right? So turnover is one particular one. Turnover is a growth metric that everybody can galvanize around. You understand it as the entrepreneur, the investor understands it, your employees understand it, everybody understands, even the government understands it. So if you said, right now we're only making £50,000 a year in revenue, but our growth objective is that over the next 3 years, we want to grow to become a £500,000 a year revenue business. Everybody can understand that. And that is a very clear picture that you can measure yourself against. Now, does that mean that all the other examples of goals and objectives that I gave earlier doesn't make sense? No. But guess what? If you are the only one and you have 50,000 in revenue as a business, by the time you get to 500,000 in revenue, you probably are not going to be the only one doing all the work to service customers at that level. Guess what? You would have hired people, right? Your hiring objective will have been met. It might be that you need to set up an additional, an extension to your manufacturing facility, and the way you get to 5 million is then to do your offshoring manufacturing that you've always wanted to do. Or it could be that, in getting to going from 50,000 to 500,000, you needed to grow from 50 customers to 220 customers. That is growth in number of customers. My point is, all the other colored brushes that we entrepreneurs use to measure growth in our mind, when your business does well, when we focus on the fundamental metrics that define business growth, turnover, profitability, you would find all of those other extras, all those colored brushes when your business makes more money, right? All dreams can be achieved. You can explore, you can play around, you can try new things however you want. So when you're going into a fundraising conversation, to bring it back to the point of today's conversation, when you're going into a fundraising conversation, an investor wants to know exactly what is the strategic outlook. Remember, Vernon talked about runways. Runway essentially means how many months you have to live as a business. How many months do you have money to operate for? When you paint your strategic outlook, right, an average, I always say to entrepreneurs, a very good average to paint is for 3 years. So over the next 3 years, this is what we're looking to accomplish. 3 years is not too far into the future that it becomes intangible. And it is not too close that it becomes like a rush. It is just about enough time that you can plan towards something tangible and actually get it executed, right? Now, if we use a 3-year time frame as an example, that is a 36-month runway. If you are raising capital for something you intend to execute over 36 months, that will help you a whole lot because number one, that is like significantly longer runway than most investors would expect. So you will get favorability from the investors. But secondly, you're giving yourself enough time to actually execute and deliver results. And thirdly, having a long runway means that you actually can focus on building the business. If you have an 18-month runway, right, you spend the next 6 months trying to raise capital. You successfully raise capital, you've started executing. Month 10, you're already beginning to think about the next fundraise. Fundraising can be a full-time job. it takes that much time sometimes. That's the reason why we're doing a session on time management next week, right? Because you've got to manage the business, you've got to manage the fundraise, and you've got to manage life, right? So the thing is, having a very clear strategic outlook is an important part of that process. It helps you set a core target. And so, what I would actually encourage each and every one of you to do right now is to set a 3 year growth objective. One objective. If there is one objective that will encompass every other thing, where would you like that? So here's a simple way to ask the question: where would you like your business to be in 3 years? Right. You got a minute. Where would you like your business to be in 3 years? In 3 years, we would love to have 3 films in market, generating. Gen-
Well, working full time as well, so don't give up the day job.
oh yeah, generating 10 million annually. Oh, how do they say in the film language? Grossing X in box office, whatever. I don't know. I just hear these things. I just make them up. Or in 3 years, we would love to be in um, 200 stores across the UK, generating monthly revenue of not of at least £60,000 a month. In 3 years, we would love to have 1,000 customers, netting us a monthly recurring revenue of £30,000 a month. Those are just random examples. Put a figure down. 3 years objective. We done? Don't overthink it. What's your 3 year objective? Tell us.
I started with money, but then I changed my mind.
Yeah.
So after 3 years, I would like my system to be operating in 5 hospitals.
Operating in 5 hospitals. Okay. Why did you start with money and change your mind to that one?
Because I thought that if it operates in 5 hospitals, I would be getting £2 million anyway. But with 5 hospitals, I'm actually getting more.
Hmm.
Why did you say this morning you needed 1.2 million?
Based on the financial model that I have made about what people I would be employing, what I would be paying for outsourcing, for the finance, everything. That's the figure that I came up with.
So
That it added up to.
let me drill a bit deep into your. I mean, this part is important, so I don't mind spending a bit of time on it. Let me drill a bit more into your mechanism for setting your goal. So you started with maybe we're going to do £2 million in 3 years, but no, 5 hospitals is better. Which is more important? Sorry, what is the end and what is the means? So this is a critical question I want you to think about. What really is the end?
The end is the money.
Exactly. So your goal needs to be about the end. The means. So here's a thought for you. If your objective is in 3 years, we want to get to 2 million. There are different ways you could get to 2 million, right? But if getting into 5 hospitals, maybe 5 hospitals decided, so 5 hospitals onboarded your product, 2 of them onboarded it on a 3 year pilot program where they were paying you virtually nothing. And then 2 onboarded it on a full payment, whatever. And all those 5 hospitals combined, you were only generating 600,000. You still have 5 hospitals, all sorted. That's your goal achieved. But financially, you know where you need to be as a business, right? So for me, because I always come back to that question: what really is the end, and what is the means? We need to be absolutely clear. I mean, sometimes I speak to entrepreneurs and I say to them, "So, what is your objective? What is your growth picture for the next 3 years?" Oh, and they say, "Oh, we want to impact a thousand people and create job opportunities." Yeah, I know the story. I know impact is important. Yes, it's the world we live in. Yeah, thank you very much. But ultimately, the thing that enables you to deliver impact is success in your business, right? There's no impact being generated if your business is not even making money or in the spaces where it needs to be. You cannot be in a well or in a pit and try to drag somebody that is in the pit with you out. You've got to be out first. and then you can let down the ladder and bring somebody else out. So you've got to make money first, so that then supports all the other things. But in any case, that is me digressing. Your goal.
Um, so great, one feature film and have a distribution deal.
One feature film, have a distribution deal. I like it. I think it could be better in that having a distribution deal is not enough. What is the value of the distribution deal?
I don't know enough about that's the whole.
Okay, so you will go do a bit of research on that, fine tune that, and then put a number on it. Because again, somebody can offer you a distribution deal for 30 grand. I'm like, okay, it's a distribution deal, but definitely not what we're looking
I
for.
think for me, it's more about access to platforms as opposed to getting money, because then that generates.
Exactly. So again, but like I said, I like it. It works. You just need to polish it a bit more. So for example, your deal could be with, so we want to have a distribution deal with Netflix, for example. That is a very, very clear goal to chase, right? But again, do your research. Don't hone in on it right now. Do your research and then paint the picture.
It's difficult for you somewhere. It's a one product wonder that it hinges on everything. It's really difficult. It's that film. How great is the film?
Yeah.
That really it makes it work or not at all, isn't it? It's just it or nothing.
And Amazon's giving 0.01 pence for every hour of film content he buys. So even if I had an Amazon deal, I would have to. I don't know how to project how many people would
Viewerships
do it.
and
So
stuff.
it's
So
really,
it's quite a
really
technical
quite
one to
tricky.
dig into.
That's why I need to speak to people that
Awesome.
have been there and done it.
Exactly.
Have this
Absolutely
conversation.
expertise and knowledge. Yes.
How are you?
I would like in 3 years' time to be in retail like you.
Okay.
Kind of, but the dream would be the £1,000,000. But obviously, I need to work out exactly what.
Yeah. Again, we'll get into details of this in one-to-one conversations. The dream is the dream. The dream is the North Star that keeps us pushing forward. But trust me when I say, oftentimes we overestimate what we can achieve in 1 year, and we grossly underestimate what we can achieve in 3 years. Generally speaking, we overestimate what we can achieve in 1 year, but we grossly underestimate what we can do in 3 years. If you have a 3 year planning horizon and you're like, I have to hit this goal in 3 years, trust me, you are more likely going to achieve that goal. But generally speaking, we all have too much expectation into 1 year. I mean, December is coming up now. Everybody's going to be making, oh, next year we're going to do this. Next year we're going to this, we're going to that. And there is no better indicator of this than to look at gym memberships, right? Gym memberships are everybody January. It's like this year is the year I'm getting fit. I'm this. And gym membership soars January, come April. It's all gone, right? So, and the thing is, generally speaking, what tends to happen to us humans is when we get inspired by these goals and these objectives and stuff that we want to achieve, we believe that, you know what, I'm just going to do this and this and this and that. And what we tend to forget is that for every goal that is worth pursuing, it almost always requires a lifestyle change. Every goal that is worth pursuing, including building a business, almost always includes in there somewhere a lifestyle change. And this could be, oh, I need to work on this specifically consistently for 2 hours a day. But then that 2 hours is going to come from somewhere, right? Because you're not going to manufacture 2 additional hours of your life. Nobody has that power, right? So the thing is, we tend to pack a lot into that. But if you have a longer time horizon and you scheme out and you have a great strategy, everything is possible. Anyways, once you have a clear strategic outlook, the next thing you then do is put an execution plan together. That is, how are we going to make this happen? So what channels are we going to use? How are we going to reach the customers? What are we going to use, TikTok or Facebook or LinkedIn? How you put a plan together and then do what we call a resource needs assessment to find out, do we have the resources to execute this plan? Once you've done that, you then put together a fundraising strategy. Because when you do number 3, when you put together a plan and you do a resource assessment, a resource assessment simply means, do we have enough money or enough resources to do what we want to do? The answer to that question is either a yes or a no. If it's a yes, then just go ahead and start executing because you already have the resources. If it's a no, that's when you decide, oh, we need to raise capital. And when you've decided we need to raise capital, you then do a fundraising strategy, which includes how much are we looking for? What type of money are we looking for? What type of investor should we be talking about? Should we be talking to? And we're going to get into some of those things in a bit. And then once you put your strategy together, then you have to put together first your financial documentation. Your financial documentation is your projections that we talked about earlier. Why is that important? Because your financials show us the impact of your strategy executed. So you're saying we're standing here in 2024. You have this 3-year objective, which you want to achieve by December 2028, right? That's your 3-year objective. And then you're saying if we do all those plans, we're going to achieve this massive big goal of 2 million a year. But let's plot that into the financials. Let's see if all the things that it would take to make this plan happen, the cost and the income and everything, by the time we compare it all together, will this be a sound business? Will this be a profitable company? Because guess what? You could actually be a 2 million turnover company and still be making 500,000 in losses. Very possible, right? So your financial documentation, what it does is it gives us a clear picture of when executed, when you've hired all the people you want to hire, you built your technology, you're spending money on ads, you're getting customers, you're engaging, you're servicing, you're doing everything you plan to do. What is going to be the financial implication? When you've done that, then you then go towards building the pitch document. The financial documentation is built to help see the future and pitch the future. Your pitch documentation essentially is helping you to communicate to the people that matter. So that's what you take to an investor, your pitch deck and things of that nature. And then you execute. The other last bit is operational readiness. So when you then want to enter fully into that space of fundraising, you need to make sure that operationally speaking, your business is sound. A very good example of that is your legal agreement. So a business is a sum of relationships. Every business is literally a sum of multiple relationships. The relationship between you, the founder, and the business, the relationship between you and a co-founder, the relationship between the business and employees, the business and customers, the business and distributors, the business and suppliers. Those are all relationships. Now, in business, every relationship needs to be governed by contracts. Operational readiness, have contracts for all your business relationships. So do you have employee agreements? Do you have shareholder agreements? Do you have letters of intent from your suppliers? Do you have, LPO from your distributor? Document. That's an example of operational readiness. Your technology, your intellectual property, are all those things secured? If you're going to be going to fundraising, all of those things needs to be there. All right. So generally speaking, in the world of investment readiness, these are the 7 steps you need to go through. But there are only 2 steps there that you will not need if you're not raising capital. If you're not raising capital, so if you get to point 3, right, and you did your resource assessment and you said, we don't actually need to raise money, we can do this ourselves. You probably don't need to do a fundraising strategy because you're not fundraising, and you don't have to do pitch documents because you're not pitching to anybody. But you still need to do financial documentation because you still need to project for your future to see if that 3 years possible or not. So the reason why I'm sharing all of this is to help you prepare your mind, really, and to help you understand that this is not all these things that we're talking about is not just for fundraising. Yes, we know that the theme of the conversation and the program is about getting you ready to fundraise, but ultimately, even fundraising is a means to an end. The end is business growth. Hence the reason why you need to have clarity around what growth looks like and how we're going to achieve it, right? And then we'll go from there. So let's talk very, very quickly about principles that would help us along this journey. So generally speaking, as a founder, the reason why you need resources is to execute a growth strategy. Remember what we said earlier. You have to have that growth strategy first, then map an execution plan, and then you need resources to map to execute that plan. So the reason why you ever need capital is to execute a growth plan. So what that means is that if you don't have a growth strategy, there is no point raising capital. The first step is How do we grow this? And it is all of these processes that would give you those answers that we're talking about in the first session, right? When you're sitting across an investor and an investor is saying, why now? Why is this going to work? It is the fact that you have clarity in your mind. You've done the homework, you've done the research, you've thought through every single part of the process to identify that, you know what, this is how we're going to grow and this is how we're going to make this dream happen. And then, if you clearly thought about it, it literally flows out of your mouth in conversations. When you have not done that work, you're going to be getting a lot of as, ems, and ums. Um, um, that's what you're going to get, right? So you need to do this first. Figure out the growth strategy, how we're going to execute it, and then we'll figure out how much money we want as a result. Again, that's the reason why we have all those three things. So as a result, you need to know what your business is, what your customers are, what your growth strategy is. We've already done this. Now let's look at the funders. We've talked about what you must do as a founder. You need to have your strategy, you need to know how you're going to execute it, and you need to know how much money you need for it. But for the funders, what are they looking for? For every single investor you speak to, the most important thing to them is the security of their capital. Think about it this way. What is an investor's business or any funder? So we generally use the term investors when we're speaking to equity investors. There are three types of money. I'm going to talk about it in a bit. But anybody who gives money to businesses, what is their business? They're making money from money. That's their business. So they give out money in whatever structure and they expect to make more money as a result of the money that they gave out.
Is there any prestige value being associated with things sometimes?
It depends on what the nature of the conversation is. So, because for example, some startups, when they go to market, so maybe they're speaking to a potential customer and they say we are venture backed, or oh, we're backed by Oak Tree Investment or something. If the VC or the funder has a lot of prestige, generally speaking, that tends to rub off on them. But it's very selective in terms of where that comes to play. It doesn't come to play in every instance. It's not a big factor. Yeah. It can be a big factor, for example, if you're raising a new round of funds. I mean, Vernon was saying earlier about Innovate UK grant. The reason why we get excited about Innovate UK grant is because if, as a founder, you've gotten an Innovate UK grant and you're going to an investor to raise capital, having gotten that grant is the first tick box to that investor that what you're doing is probably innovative, because they know that the Innovate UK process is very, very tough and very difficult to get. So for you to have gotten it, there must be something about your business, right? It's an indicator. So that's a very good example, an instance of that prestige rubbing off, right? But generally speaking, when it comes to funders, the most important thing to them is they don't want to lose their money, because that is what their business is based on. So when they are evaluating founders that they want to invest in, they're literally asking themselves, is my money safe with this person? Do I trust this person with my money? Right? And remember, depending on the type of funder, the money is not even their own personal money. They are managing money on behalf of the public, on behalf of certain investors. So they literally look at the investment decision as to, first of all, is this a safe investment to put money in? Is there a likelihood that we're going to lose the money? Either based on the issues that surround the business or the credibility of the founder. Yeah. They're looking at these things. Only when they've satisfied themselves to the degree where they say to themselves, we think that this is a relatively safe investment, do they then think about returns? Yes, let's make sure we don't lose our money first. And if we don't lose our money, let's then make sure that we make money in return, right? And then the third part of it is strategic alignment. Investors want to invest in things that help their portfolio. In fact, depending on the level at which you're seeking investment, a lot of investors, particularly the venture capital firms, they clearly and openly talk about the verticals in which they invest. So some people will tell you, for example, we're a fintech fund, or we're a med tech fund, or we're a creative industry fund. They're literally saying to you, this is the vertical that we invest in, no more, no less. Right? So generally speaking, that is that investor trying to find investment that aligns with their own strategic interest. And that strategic interest could be for many different reasons. It could be because, that is their area of expertise, right? So they've previously invested in businesses of that type, they know what to expect, and they believe that they can add a lot of value, right? It could also be because, they're looking for something to complement their portfolio, right? So it could be because they feel that, oh, if we invest in this business, their success is going to open doors for these other businesses that we have. Or if we invest in this business, we already have other businesses in our portfolio that can help them get into the spaces that they want to get. So it's all of that alignment that they're looking for. So as a result of this, it is important for you as a founder that you respond to those interests. Generally speaking, investors want security of their capital. And so what do you do in response? You need to make sure that your business is sufficiently de-risked. What that means is that when an investor looks at your business, they don't see it as a very risky proposition. And there are a number of things that you can do without money to actually de-risk your proposition. So the conversation we're having earlier about ideas don't get investment is all about this de-risking issue. Because if it's an idea just sits in your head, it's never come to life, you haven't executed it, you haven't built it, you haven't tested with customers, you just believe that it's going to work. There is no basis for your belief. It's very risky, right? But if you've already built the technology, you've tested it with 50 customers, and you have evidence to show that there's great feedback, or you have people on your waiting list that are waiting to buy, even though that's not sale, even though that money hasn't come into your business yet, the investor sees that and says, this is a very clear indicator that there is an interest in this thing that this founder is doing. That is de-risking the proposition, right? Because of time, I'll move on. Demonstrating return potential. Whatever you can do to demonstrate that this business will make money, then you have to do that. And then the third is making sure that your story is aligned with the interest of the investor. See, when interests are aligned, deals are struck. If I'm trying to hitch a ride to London, it doesn't matter that you have the latest, finest, most technologically advanced car if you're traveling to Manchester. I may love your car and love you, but I'm trying to go to London, not Manchester, right? So if I find somebody that's going down to London, oh, then we can go together. So when investors feel that, you know what we're trying to achieve, this business can help us achieve it, or the purpose for which our fund was founded, if we invest in this business, that purpose will be met. So when those interests are aligned, then you find deals. Investors will say yes to you. So one of the things that I always encourage founders to do is be laser focused around a small set of investors that you're looking to get money from. Do your research about them, and then use the insights that you find out about that research to tailor how you deliver your pitch. Right? So for example, if I use again, this is a female founder cohort. If there is a fund that only specifically invests in women entrepreneurs, right? And I'm doing a pitch, like I'm a female and I'm doing a pitch to that group, right? I want to highlight the specific challenges that are faced in the market. Why? They can relate. That is why they created the fund in the first place. And so I want them saying, this is why we do what we do, to help founders like this. You see my point, right? That's why it's important to align your story. Anyways, how do you determine how much you're looking for, right? A critical question to ask. Now, generally speaking, your ask is comprised of three things. First is the cost of executing that growth plan. That's the first thing. The second thing is any cash flow shortfalls that exist in your financials. The third is a cushion for unforeseen circumstances. The chunkiest one is the first one, the cost of the growth plan. How do you come about that? Well, the first thing is, where are we today? You have a very clear idea of where the business is at today. Then the second thing is, what is our objective. Remember, we said the 3-year objective late earlier. Once you identify the 3-year objective, we said get that objective and put together an execution plan. Well, the next thing is, before you settle on that execution plan, research what are the different ways of executing this. What are the different paths? What are the alternative paths that could get us to this objective that we're looking to get to? Because, so for example, if let me give you a simple example to illustrate this. If I am a £100,000 a year business, yeah, please pay attention. If my business generates £100,000 a year, and I want my business to grow from £100,000 to £500,000, yeah, there are many different ways I could do that. One way could be that I increase my prices. That could get me to 500,000 without doing any other thing. I just increase my prices. It could get me from 100 to 500,000. Another way is I could get more customers. That could get me to my 500,000. Another way is I could get my existing customers to buy more products, so introduce more products. Does that make sense? That would also increase how much money I make per customer, right? Or I could increase the number of channels through which I'm selling. So let's say I only sell in one outlet. I then expand that to 5 outlets. If I can replicate the success of one outlet, that will get me to my 500. My point is, there are many different ways to skin the cat. There are many different ways to get you to an objective. There are many different ways by which you can achieve any particular goal that you've set. But generally speaking, as entrepreneurs, we tend to default to the path that is familiar to us. Even though your familiar path might not be the best path. Remember, when you're speaking to an external stakeholder like an investor that is evaluating your business, they're not going to be evaluating your business based on what you know. They're going to be evaluating the business based on what they think is best for the business. So if you've got a marketing plan that literally will cost you £80,000 to execute over the space of 1 year, but then there are modern methods that you literally will spend like 10 grand and get the same result. It doesn't matter that the 80 grand plan is where your expertise is or where your experience is. An investor is going to be saying, you're literally just wasting money because you could spend a fraction of that to get the same result. Right? So generally speaking, my challenge to you is when you're trying to figure out how much money you're looking for, alternative paths, right? Is building an app the only way to do this, right? Are there other ways to do it? When you've done all of that research, then you can settle on a particular path. You then select one. When you select that path, then you do a costing of that path. So if we've selected, let's say for example, we've selected that the way we're gonna grow this business is to get a marketing intern is to get TikTok active, right? We literally ask ourselves, okay, so what are we going to do in order to get TikTok? I don't have TikTok expertise. So let's say I'm going to need a social media manager to manage the post and the engagement. I'm going to need somebody to create the content, or maybe not. Maybe I'm just going to batch create content, pay a videographer like £1,000, create content that is enough for like 2 months, and we just post that and recycle that. And that is you literally figuring out the cost of that path. Now, once you've determined that cost, then you can add the cushion that we talked about earlier. So let's say the cost of your execution is probably, say, 160,000. Then you can add like 30,000 or 40,000 as a cushion to make it 200. Because the thing is, anybody that has ever run business knows that once the rubber hits the road, the plans change. Right? It's never exactly how you imagined it. There will always be something that you never thought of that came up, right, in the market, and you need to be agile enough to be able to respond to that, right? If your plan cost 150,000 and you literally raised 150,000, when the shock comes into the system, you don't want to go back to the investor saying, well, we didn't see this coming, but it has now happened, and we need another £50,000 to take care of this. They're just going to look at you and say you're not serious, right? But if you are that entrepreneur that says, and they grilled you about the details of your plan, and you say, oh, this is what it's going to cost, and they say to you, oh, your plan only costs 250,000. Why are you looking to raise 300,000? You just say to them, oh, well, our plan actually does cost 250,000, but we know that business can be unpredictable at times, so we just have a 50,000 cushion to ensure that we are ready for any eventuality. That shows that you're a forward-thinking entrepreneur.
It's better to tell them that you stand by it
Absolutely.
than try and predict it.
No, tell them, like, this 50K is just a buffer, just to ensure that should there be any shocks to the system, should there be any challenges that we did not foresee, we will be able to take care of it. Please be very upfront about that. And then tie your asks to milestone and timeline. So this is the milestone objective. These are the checkpoints. So for example, when you have your 3-year objective, you need to have a 12-month and a 24-month checkpoint that literally is an indicator that tells you that you're on track for your 3-year. That's what we mean by milestones or timelines. So at the 12-month point, what must we see to ensure that we are on track to hit our 3-year goal? At the 24-month point, what must we see to ensure that? I mean, if you're trying to grow from 50 customers to 500 customers in 3 years, and if you then say to yourself, oh, to go from 50 to 500, at month 12, we should be at 120 at the very least. The jump from 50 to 120 doesn't seem so scary like the jump from 50 to 100. So even the milestones and timelines help you in terms of how you approach your goal setting and that conversation. Very quickly, this will probably be where we're going to wrap, to talk about the different types of money, because I think that ultimately this is a critical, fundamental piece of knowledge to set the foundation, both of business and of fundraising. So generally speaking, so we're talking about the source, and there's this word called capital structure. Capital structure is the term that accountants use for what I'm about to explain. Essentially, what it means is it refers to how your business is financed. Right? Where does the money come from that funds the operations of this business? Now, generally speaking, money can come from two broad areas. They could be internal capital or external capital. So internal capital is money that comes from within the internal environment of the business. So we're talking your savings as the entrepreneur. We're talking the money that you put into the business. We're talking money that you generate from sales. All of that is internal capital. Now, oftentimes, depending on the scope of your goals, the internal capital is not enough to achieve the goals that you have. Hence the reason why we then look at external capital, which literally means what it says on the tin: money coming from outside, money coming from outside the environment of this business. Now, potentially, when we're thinking about external capital, where does that money come from? There are only 3 types. It's either a grant, or it's debt, or it's equity. Now, these 3 types are defined based on the structure of that money. In other words, when people give you that money, what are they expecting in return? Because again, it's a commercial arrangement. It's something, yeah, go for it. Yeah.
What about sponsorship?
Sponsorship is external capital. It will be classified under grant.
Okay, but it's a free grant.
Say again?
So it's a free grant.
Yeah, pretty much. So let me explain those 3 structures. So grant is when somebody gives you money, right? In exchange, so the money itself is free, but they're giving you the money so that you can help them accomplish an objective.
Right. Help them accomplish.
Yeah, they're giving you the money so that, because they see that your business will help them achieve something that they want. Innovate UK gives money to businesses because they want entrepreneurs in the UK creating innovative businesses. Right? So because their own objective as a government agency is to drive innovation, that's their objective. So anybody that they see that is actually doing something really innovative, they give them money to support them. And so they can then say to the government, oh, we're driving innovation by funding innovation. When Birmingham City Council says, you know what, we need to reduce the energy consumption in this city, what can we do? We'll put a grant together and say to businesses, if there's any business that is looking to swap out their equipment for energy efficient ones, we will give you half of the cost. Half of whatever it costs you to do that, we'll give you half of the money. Guess what? A business that I've been thinking about swapping out their noisy refrigerator and all the other equipment for forever, and I've been balking on the cost, suddenly says, whoa, I'm getting free money for half the price, right? I might as well just do it now. And that stimulates them to make the change. But guess what? Birmingham City Council have achieved the objective. So when people give grants, they give grants to organizations or businesses that aid the accomplishment of their own objective. That's grant. Debt is, I'm sure we all know what debt is where somebody gives you money in exchange for, they expect you to pay that money back with interest, with or without interest, depending on where you got the money from. So sometimes you get debt from family and friends and they don't charge you interest, but sometimes you get credit card debt, you charge you interest, bank charge you interest, all these other providers will charge you an interest, right? But essentially, debt, the structure of debt is, I give you 10,000, you have to give me back my 10,000, but when you give me back, you have to give me back with interest. The priority of a debt provider is that you are able to return the capital and that you're able to return it with interest. So they want to establish that you have the cash to be able to do that, right? And then the last one is equity. Equity essentially is when somebody gives you money to become a part owner of the business, right? So they give you the money. What they're literally buying is a share of the ownership of the business, right? Now, these are the three types of money that exist. You may have heard about crowdfunding before, yeah? Crowdfunding is not a distinct type of money, it's just a different format of getting the money. And essentially, what it means is, as opposed to getting the money from one person, you get it from a crowd of people. So as opposed to getting £100,000 from one organization or one person, you're getting £1,000 from 100 people. That's what crowdfunding is, right? So generally speaking, these are three types of money. What you use would be largely dependent on the nature of your need and the stage that you are at. Generally speaking, early stage, pre-seed stage businesses use a lot of grants and debt and equity, but at different levels. Because again, for these are just the three types. There are different levels to this. Innovate UK grants are the grant. Innovate UK is the organization that gives the biggest grants in this country, right? They have grants of even 150,000, but most of the other grants are like £1,000, £2,000, £5,000, £15,000. You don't. With debt, for example, you could get credit card debt, right? That's very easy to get. You could get, and we're going to talk about this as we go on the program. But you could get, what's it called? British Business Bank, startup loans. You could get a loan from the bank, right? And then there are all sort of other debt instruments. So, for example, there is something called invoice financing, which is where somebody literally loans you money to fulfill an order. And when your customer pays you, you pay them their money and you take your profit, right? So there are all sort of debt instruments. With equity, there are equity at various levels. So, for example, we have angel investors, which is when individuals that are high net worth individuals are investing their money in businesses. And then we have venture capital firm, which are organizations that are money managers. So they go borrow money from like pension funds and massive institutions, university endowment funds. They take that money. They say to the universities, we're going to manage this money for you and make you a profit on it. The university gives them the money. They then take the money and invest in promising businesses. That's what VCs do, right? And then above venture capital firm, you then have what we call private equity. These are large financial organizations that borrow crazy sums of money to buy massive assets. So, for example, I think it was Morrison's that was recently bought by private equity. But generally speaking, the way private equity works, they buy assets worth like, say, £500 million or £1 billion. But then they literally would borrow like 80% of that money. So, for example, if I wanted to buy a £1 billion asset in private equity, I would borrow 800 million and put 200 million of my own money to make the 1 billion. I would then pay and buy the asset, but then the 800 million I borrowed would not be a loan on me. It's going to be a loan on the business that I bought. It's a very funny, crazy world. But my point is, there are many different types of equity, many different types of debt, many different types of grants. So which you use will be based on your unique circumstance as a business, and we are going to get into all of that on a one-to-one basis. I'm sure that there's going to be somebody out there waiting for me because I've got a client meeting, a one-to-one, which we're going to be having with you guys as the days progress. But generally speaking, that is how you determine the ask. In this session, what we've covered is figuring out your ask, the importance of setting a very clear objective and having a very clear roadmap and strategy to execute that objective. My challenge to you is that as you leave here today, optimize those three things. So, what is the objective? You've already set some objectives here today, right? If you need to do a bit more research to fine tune it, do that. Once you've done that, then do the research around how do I achieve these objectives? What are the different plans, the different alternative ways to think about this? And then once you do all of that, you then settle on, I think that this is going to be the best path forward. And if you can, it could be a rough sketch as to a detailed costing of your plan and what that is going to come to in terms of your funding ask. But again, like we said at the beginning, and this is what I'm going to wrap up. It's not just about this session. These sessions are educational. Yeah. It crystallizes for you in the one-to-one conversations, because I remember you were saying at the beginning you wanted to explore a few more ideas as to what you can do to set up and not just make it selling your time personally on a perpetual basis. Those things get crystallized in one-to-one conversations, and we're going to make that happen. But I hope this has been very valuable. Fabulous. Thank you very much. We will see you next week, bright and early, 10 a.m.
Yes. Yep. Hopefully be one more of us next week as
well. Yeah. Awesome. Hello. That's my 1 p.m. meeting. So she's the reason why we had to finish bang on time. No worry. We've literally just finished. You can